Hello and welcome to another episode of Ken Training, where we want to give you the training that you need to tackle projects like this one on your own. Today's project is not really so much as a project as it is instructional video, educational video on a stock market strategy that I'm just referring to as the wheel strategy for a diversified portfolio. When it comes to the stock market, there are so many different types of strategies that you can invest in. There's the buy and hold strategy. There's some people that just play options as an option strategy. There's people that play something called Forex and currencies. There's some people that do day trading. So there's a lot of different strategies out there. And trying to find the correct strategy for you and your personality and how much time that you're wanting to invest into your strategy will determine on what works for you and what doesn't work for you. I have tried a lot of different strategies over the years and different types of ways to invest in the stock market, and I have found that the strategy that I'm going to present to you today has worked very well for me as a DIYer, not a professional trader, with pretty good results, comparing them against the S&P 500, which is to me the benchmark that we should be comparing our trading results to. Because if I can't beat a buy and hold investor in the S&P 500, why in the world would I trade? I would just simply buy the S&P 500, hold the position, and just sit tight. And people who are not wanting to put the time and energy into this type of strategy, that would be an appropriate way for you to invest your equities, just to hold the S&P 500, which is the 500, basically the 500 strongest companies in the United States, according to the Standard & Poor's Index, the S&P 500, which is a standard benchmark across any type of people that follow the stock market. A lot of people refer to the Dow and the Dow 30, but that's only 30 stocks. It is the 30 top large cap companies here, but the S&P 500 has 500 companies, so it's much more diversified than the Dow. So I am going to give you all this in this video and as quickly as possible. If you're the type of YouTube viewer that just wants a 5-second video because you have an attention span of 5 seconds, this is not the video for you. It's going to take just a little bit of time for me to show you the whole strategy here. But I'm going to give you this entire strategy for free. I am only asking for you to do one thing for me, and that is to smash that like button down right now to help promote this video. Okay, with that said, let's get into the strategy and how to do it. Okay, and here is our strategy, wheel strategy with the diversified portfolio. This strategy, which is going to take you about 1 to 2 hours of time invested per month in order to implement this type of a strategy. The strategy should achieve returns of 12 to 20% annualized in a diversified portfolio with 25% invested towards stocks, 25% towards bonds, 25% into real estate, and 25% into precious metals. The strategy uses cash secured puts to enter into positions and covered calls once in the position. That's what we're referring to as the wheel strategy, because it's kind of like a wheel. The timing of the transactions is based off of cycle timing. The strategy that I am going to present to you, I don't believe anybody else has ever presented this exact strategy with this breakdown in as far as the percentages into stocks, bonds, real estate, and precious metals. So as far as I know, it's a unique strategy that has not been put out there. So you are getting fresh, clean content that you've never seen before in any other page, to my knowledge, or any other website. Okay, the ETFs that we're going to use for the strategy are the SPY, which is ETFs is, if you're not familiar with that term, it's basically an electronically traded fund. Think of it as a mutual fund that trades like a stock. We're going to use SPY, which is the S&P 500 for our equities, TLT, which is for bonds, VNQ, which is representing real estate, and GLD, which is gold, representing our precious metals allocation. We use ETFs for the trading instead of stocks to have instant diversification and no need to track earnings release dates. Entering into your first position, you will need for this strategy for a diversified portfolio an appropriate amount to start off with to even implement this strategy is about $200,000 to create a diversified portfolio. If you have less than $200,000, just grow your portfolio with the S&P 500 mutual fund, such as the Vanguard S&P 500 fund, symbol VFIAX, and add to it every month with 10% of your income from your day job by dollar cost averaging, adding to your position, and you'll be at your $200,000 in no time. Your portfolio balance divided by 4 will be the amount to allocate to each asset class. An example would be if you have $200,000 divided by 4, that's $50,000 to each asset class. The reason this is why we need the $200,000, because when you buy one contract of the S&P 500, and we're going to enter into our first SPY contract as a cash secured put, you need about $41,000 based off of how much SPY is trading for. So just to do the one contract, that's what you would need, and that is why we are saying you need $200,000 to get going with this portfolio strategy. Entering your first position, you're going to need $50,000 into the ETF, each ETF, SPY, TLT, VQ, GLT. First, we're going to focus on SPY. You can open up your favorite stock charting platform, and my favorite happens to be stockcharts.com. I like to use a 6-month chart with candlesticks and 10, 20, 50, 100, and 200-day simple moving averages. And of course, there are plenty of videos on exactly what all this stuff means. If you're new to charting and you don't understand any of these terms, you can look up each one of these ones here. But if you are not new to these and you understand what I'm talking about, well, let's move on. Now, basically, here is a chart from stockcharts.com, and this is the chart of SPY on a daily chart. It's currently trading at when I pulled the chart up, which was on Friday, it was trading at $443.91, and that was I think on September 19th or something like that. No, I'm sorry, it wasn't the 19th. Maybe it was September 24th or 23rd or whatever. But anyways, when I pulled up this chart, on Friday, this here is what the chart looks like. Now, the candlesticks are these here. These are called candlesticks, and a candlestick gives you information. As an example, this candlestick here that's in the red tells you that we opened here at the top part of the body and we closed at the bottom part of the body, but the trading day was in between the wick of the candle, the top part and the stem part here at the bottom. That was the complete trading day. So it kind of gives you an idea of what happened during the day. A really quick visual when you're looking at your candles. Moving averages. So the blue line up here, that's representing the 10-day. The red line represents the 20-day moving average. The green is the 50. The pink here is the 100, and the black is the 200. You can tell by the configuration how everything is nice and solid. There's no crisscrossing or anything like that. That this SPY is in for the past few months, half a year at least, for what you can view on the chart here. We've been in a strong uptrending bull market. You can tell all that just by the way that the chart looks. Now you'll notice that there's lows here, 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 and here. And I just wrote down how many days it is in between each of these cycle lows. So and I took the midpoint of these two lows from here to here. So it was 23 days, 23 days, 22 days, and 21 days. So we know that we're averaging about 21 to 23 days per cycle low just from looking at the chart. And we know that the last low was achieved right here on this day, which was about September 20th, 2021. And we know going out 21 to 23 days that the next cycle low should be about October 19th to October 21st. Now, technically speaking, this is what they call a cycle breakdown, where this low was lower than this low. See how all these lows here are higher than the previous lows? That's confirming your bullish uptrend. Now that we've had a cycle breakdown, the first cycle breakdown in a long time, it is possible that this could be a turning point for SPY, and SPY is going to start to what they call roll over and come down this way. We don't know that for sure. It's not confirmed, but if we get another lower low, lower than this low created here, about $430 a share, lower than that, that would be another cycle breakdown. That would be two cycle breakdowns in a row. That's telling you this market is rolling over to the downside, and there's more downside ahead than upside. Now, so that gives us an idea what the SPY chart looks like. Now, SPY just experienced a 5% correction. That's from this high over here to this low right here. But the long-term trend is still bullish, as determined by the 50-day being greater than the 100-day and the 100-day moving average being greater than the 200-day. Today is 9/26/21, and if we were to wait to enter a cash secured put for SPY on 10/19/21, we would lose about 3 weeks of trading time. We will enter the trade as soon as possible by selling a cash secured put on Monday with an expiration date of 10/15/21. SPY is currently trading at $443.91. The chart shows the last cycle low of $428.86. Let me show you where we got that. That's right here. That cycle low was let's see what it was, $428.86 on the tail of 9/20/21. We will round that to about $430 because this goes to $429, and we like to do things in even numbers when we can because most of these trades are going to work out better with even numbers if you can do it that way. With the stock price, with a strike price of $430 and with 10/15 for the expiration date. So now what we're doing is we're setting up our cash secured put options trade. We have a strike price, we have an expiration date. Now we just have to determine what the premium is. You can get these premiums from any of your brokerage houses or even just from Yahoo on the Yahoo Finance will give you the price. So when I pulled this up, the premium at that time was $2.49 a share. Options are traded in 100 share blocks. That's what an options contract always works in 100 share blocks. So that's how they work in hundreds. And with that, we needed to do 200. So with one contract, because we're going to do one contract, it's $2.49 a share. We're going to get a premium of $249 is going to be the premium received for doing a cash secured put. We plug those numbers into our cash secured put calculator, which is this right here. This is our cash secured put calculator, and that is telling us that, so here, let's just go through it. You have one position, the symbol is SPY, we're going to do 100 shares. The real or proposed purchase date is 9/27/21. The options expiration date is 10/15/21. And now we know that the number of days for this trade is an 18-day trade. It has a time value of $2.49. And the cash required to enter into this is $42,751. The break-even costs, which is your strike price, minus the premium that you received is going to be 427.51. And the return on the option, if it's flat, is going to give you a 0.58% return on your option. The return on the option premium is $249. And if we do get exercised because SPY is going to be trading below our strike price of $430, then at that point in time, we are going to have purchased in the shares for at 3.69% below its current trading price. The profit on the trade is going to be $249. Profit or loss on the trade on a percentage basis is 0.58%. And if we annualize that out, we're going to get 11.81% for an 18-day trade. That would be an annualized return right there. So let's see here. That is currently 3.9. It said no matter what happens with this trade, we're in a good position. Unless SPY were to drop below our break-even price, which is this column right here. If it were to drop below 427.51 by the expiration date, if that were to happen, we would be at a loss on the trade. Of course, anything can happen, and there is no guarantees, but the probability of that happening is 21% according to the Thinkorswim trading platform. So down here is the Thinkorswim trading platform, and here you can see that we have our expiration date of 10/15/21. These here are the strike price columns right here, and let me just show here. Okay, so here you can see that the probabilities of being in the money is between 20 and 21%. And that is how we came up with the probabilities of being, according to what the experts say who price the options. They say it's a 21% probability. So you have 80% probabilities that this is going to expire out of the money, and you are going to not hold the shares, and you're going to walk away with a return of 11.81% in this trade. On a worst case scenario, SPY drops down below your strike price, you get executed, you will own 100 shares, you have the money in your account to back it up, so that either way you're safe. You're going to either acquire the shares at a discount, or you're going to receive and accept and hold the premium. Your option will expire worthless, and you just got for the 18-day holding period an 11.81% annualized return. So basically, that is how we are going to do all of our positions. Mind you, we only put 25% of our portfolio into equities, and that is how we're now going to do our diversification. Okay, now let's enter into our next position. We're going to put 50,000 into bonds, and that's the bond ETF, 20-year bonds. We're going to pull up the TLT chart. So here's TLT, iShares 20-plus year Treasury bond ETF that's traded on the NASDAQ. Now, when I pulled up this chart, you can see the chart pattern here, and you can see how the lines kind of crisscross, how it looks so much different than the SPY chart. And you can see that when I pulled this up over the last 4 trading days, it has basically fallen off of a cliff. But if you look at this as a rectangle, this looks like a trading range, and we're at the low end of the trading range right here. I've also marked off how many days are in between each of the trading cycles, and we're averaging somewhere between 13 and 18 days. And right now, at this day right here, it was at 14 days from this trading low to this day. So it's 14 and adding, because the low hasn't been confirmed yet by change of direction trend. Okay. Now, you can see how different the TLT chart looks compared to the SPY chart. That is because this is bonds, and they move differently than equities. This gives us our diversification. We can see that over the past few months that TLT is hitting a cycle low about every 13 to 18 days apart. We are currently 14 days out, And the low achieved today is the same level it was in mid-August, making that a double bottom. Let me show you that double bottom. Here and here are about the same. So that if this holds and goes up, that would be a double bottom. If this breaks that bottom, then that would be a breakdown. Okay. Also, TLT has just lost about 3.7% over the last 4 trading sessions. That appears to be a good point for our strike price. This is where we're trying to develop what our strike price should be. We're saying 146. 146 is right here. It's where that low occurred. It's where our current low is. And that appears to be a reasonable bottom on this chart. We will go out to 10/15/21, which is, by the way, the third Friday of the month, which is on normal options expiration date. That's when most, generally speaking, this is when the options expire. Of course, you can have options that trade more frequently. SPY is one of those um, contracts or those equities that basically has so many traders on it that there's trading every 2 days or every 3 days. There's a lot of options contracts on SPY. But when you go to like VNQ, you can only trade that one monthly, which means the third Friday of the month. So it's a highly traded day. Now, for our expiration date, that's 14 trading days from now, which falls into the 13 to 18 day cycle timing low for us. To allocate as close to our $50,000 allocation, we will need to enter into 3 contracts and set aside $43,000. So you see the calculator down here? So position number 2 is TLT bonds. The implied volatility is 14.7. The higher the volatility, the higher the premium will be, by the way. The stock is trading at 146.51 a share. The option premium we're going to receive for this is $1.76 with a put strike of 146. The number of shares is 300, and that's based off of how much cash is required. We were trying to get this number to be $50,000 because that's our allocation per the asset class. This is our bond asset class. And we have the proposed or real option purchase date of 9/27 with the expiration date of 10/15/21. That gives us an 18-day trade. Now it tells us all of our information here, our break-even costs, return on investment at flat. The premium that we're going to receive for this is $528. How much percent discount we're going to receive if we get exercised, the profit or loss on the trade, and look at your annualized return for this trade. You're going to get a 24.74% annualized return. So you're not getting as much on SPY, but you're getting diversification here by holding 2 different asset classes. You're getting a better return on bonds. You blend that out, and you can see that you're annualized already getting a return annualized of somewhere in the neighborhood of, let's just say 18% or something like that with just these 2 positions. And you've got a diversified portfolio with just these 2. Now, what is the probability that you're going to get executed on this trade? Well, we look at our break-even costs here of 144, and it's 32%. And if you take the 146 that we got here, it looks on this one here that there's a probability of 46% that we're going to get executed. So it's still less than 50% that we're going to get executed on the trade. But if we use our break-even numbers, because that's when we would actually start to lose money, you can see that there's a 32 to 35% probabilities that we're going to lose money on this trade. So the probabilities, we've got a 70% approximately, 65 to 70% probability that we're going to be profitable on this TLT position. And that is how you do that. Let's move on to the next one. Next one is VNQ, which is real estate. Pull up the chart. You can see how it's got that bullish trend to it, just like SPY did. But it kind of trades like SPY because it is an ETF, it is an equity, but it's based off of real estate from the Vanguard Real Estate ETF. You can see that we're off of the highs here, but we're in a bull market. We can see that over the past few months that VNQ is hitting a cycle low about every 20 to 26 days apart. Let's see that. 22, 26, 20, 23, and 21. You can see those cycle lows right there. We are currently 5 days out, and that puts the next cycle low at 10.25 to 11.2. VNQ is apparently in a trading range from 110 to 101. Let's look at that. 110 is right here, and 101 is right here. So we're taking this huge trading range that we're trading in right now. So I think that 104 is a good strike price for us based off of that cycle low. So where's 104? 104 is right here. See that last cycle low is right there? So we are getting just the bottom end of that low right there. That is currently 2.07% below the current trading price, taking into account the 93-cent premium we received. No matter what happens with this trade, we're in a good position unless VNQ drops below 103.07 a share. If that were to happen, we would be at a loss on this trade. Of course, anything can happen. There are no guarantees, but the probability of that happening is 30%, according to the Think or Swim trading platform. So here's our position VNQ, and we're going to get 5 contracts or 500 shares. That gives us 51,535. We're trying to get as close to 50,000. You can see we're under 50 on these two, so we're a little heavy. We went, right up plus another grand or 1,500 on this VNQ trade in order to get a solid 5 contracts. Now we are going to get a return on investment on VNQ of 18.3% annualized for this position. And here's your Think or Swim trading platform. This tells you the options expiration date is October 15th, 2021. And if you look at our break-even costs and you carry that over, it has a 30% probability that you're going to be in the money at expiration date, which means that you have a 70% probability that you're not going to own the shares, or you're not going to be at a loss on the trade, I should say. You have a 70% probability that you're not going to be at a loss on the trade. Let's enter into our last position, 50,000 into GLD, which is gold, precious metal ETF. Let's pull up the gold chart. Now, look at this chart and how different it looks than the other charts that you saw. The lines are just going back and forth, and they are absolutely crazy. Now, one important, there are many important things, but the green is the 50-day moving average. The black is the 200-day moving average. The 50 is trading below the 200. And the ETF is trading below both, meaning that this is further dragging down. Technically, you're in a bear market when the 50 is below the 200. They call that the cross of death, when the 50 crosses below. When the 50 crosses above the 200-day, they call that the golden cross. Here you can see you had a golden cross, and it didn't last. Came down, and then it went through the death cross. The death cross, 50 crossing below the 200. And then when that shortly, right there, when that crossed, you can see you hit just about a low. Then it popped up right there, and then it didn't hold, and then it's come back down. This could be a double bottom at this point in time right here. But on the brighter side, there's what they call a positive divergence. I have 2 momentum indicators on my chart. This is the MACD moving average convergence divergence with default settings. This is the slow stochastics with default settings. Now I know the slow stochastics a little cut off right here, but looking at the MACD, you can see that if you grab the bottoms of these trend lines, we have an uptrend. Here on the trading, the actual trading, you have a downtrend. So that's showing the internal strength on a momentum indicator of the MACD compared to the actual trading. In other words, this could be the actual low, and this is going to hold, and this is going to start to either trade sideways to up. No guarantees. You never know what's going to happen. Everything is probabilities, okay? Now, we can see that over the past few months that GLD is hitting a cycle low every 18, 32 days apart. Now let's look at our cycle lows. Low, low, low. And we're calling that a low there and that a low there. And you can see that you could call other things lows, but this is just trying to put some information into our information here. So take everything with a grain of salt. This is not an exact science. It's a little bit more of an art. So here it's very, let's just use the term not clean as far as what your cycle lows or your cycle timing is on the GLD chart. The patterns are very hard to follow, and the 50-day is below the 200-day moving average, which puts us in a bear market for GLD. This requires more leeway to the downside than an ETF in a bull market. The last cycle lasted 26 or 32 days, depending upon where you take the cycle low reading from. Let's go back. You're going to take your low reading from here. It's 26 days from here to here. If you take it from here, then that would be 32 days. Depending upon where you take the cycle low reading from. If we take 26 days, then due to the lower low being put in a few days later, we would consider that a cycle breakdown. And the lower prices are, the probability of lower prices ahead is greater. If we take 32 days as the last cycle duration, then we could consider trading sideways to higher for the current cycle. In either case, a strike price of 161 would allow us some cushion to downside protection. Let's look at that. 161 is right here. Carry that across. That's below where we currently are located, and it carries us over to the last cycle low over here. So the probabilities of us holding, bouncing, or trading sideways at the last cycle low is reasonable to assume rather than slicing through it and continuing down. That is currently 2.38% below the current trading price, taking into account the $1.12 premium we receive. No matter what happens with this trade, we're in a good position unless GLD were to drop below 159.88 a share. If that were to happen, we would be at a loss on this trade. Of course, anything can happen and there are no guarantees, but the probability of that happening is 27%, according to the Think or Swim trading platform. Now, let me move myself here. And now, I pulled up two different scenarios for GLD because I was trying to determine what the best expiration date would be. GLD trades a reasonable amount, so you don't necessarily have to get it on the third Friday of the month. You could push it out. And with the way that the cycles were working, I kind of wanted to push it out. But when I plugged the number into our cash secured put calculator for Excel, if I push it out to my preferred options expiration date of 10/29, that's going to give me an annualized return of 12%, 12.3%. If I stuck with the third Friday of the month, which is when most traders trade options on the expiration dates, it will give me a return of 14%. It'd be an 18-day trade instead of a 32-day trade with a higher return on investment. So why not go with a shorter duration with a higher return on investment? So we will stay with the 10/15/21 as our expiration date. And that would give us our fourth position. Now, in order to do that, we need 3 contracts or 300 shares, and we have 47,000. Now, you see, this is why I said that we need a portfolio of $200,000. That gives us enough money to do enough contracts, especially with SPY, only one contract at $42,000, to give you your diversification in all your different asset classes. This is why I said at the beginning of this why you need $200,000 for your portfolio. Now, let me see here. We have our 4 positions here, and it tells you how much of an investment you're going to have total invested out of your $200,000 portfolio, 185,000, 15,000 in cash. You're going to get this much cash for selling these options because you're going to sell these options to open. You're selling a cash secured put. Now look at your return on investments, your annual return on investments. You are ranging from 11.8 all the way up to 24. Average that out, you're going to be somewhere in the neighborhood of 17%. You remember at the beginning of the video I said you're going to get somewhere between 12 and 20% annualized. This is how much work you need to put into this strategy once a month, and if you do that, you can achieve those returns in a diversified portfolio. You have 4 different asset classes here with 4 different ETFs, and this is how you can achieve your returns, your diversification, and you're going to be pretty good. You'll get a pretty good rate of return doing this. Now, just to finish off on the GLD position, the probabilities of being in the money at 27.7%. So again, you have a high probability of being out of the money on GLD here. Okay, so now this is what our position allocations look like on a pie chart. Okay, so you can see that I have a little bit more than just the 4 asset classes that you saw earlier. Here I've got SPY, the Dow Jones Industrial Average, QQQ, the NASDAQ 100, IWM, small cap, Russell 2000. VIG is a Vanguard dividend ETF, and there's other. These here are your sector funds of these are the sectors that make up the S&P 500. But rather than having to deal with all of this other stuff, if you just stick with the 4 asset classes that I gave you at the beginning, those are 4 solid basic asset classes to give you good diversification. And if you look at your pie chart, you can see how much you've got allocated here. So the cash position is right here. So you're going to have about 14,478 in cash. And then here are your other allocations. Your SPY is going to be this one right over here. And then let's see here, your VNQ is this one, the bonds is this one, and then the other one has to be GLD. Let's see if I can find that. Oh, I'm sorry, this one's GLD and this one is SPY. So anyways, this you can see how you don't have all your eggs in one basket. You've got pretty good diversification with this with this asset allocation. Okay, that is going to wrap up this trading educational video. This video was made for educational purposes only and not to be construed as educational advice. Get that from your own financial advisor. But I believe that you got a solid strategy that was presented to you that I don't believe you saw anywhere else. Please go ahead and hit the like button now if you have not already done so. Subscribe to my channel, Ken Training. I am going to do my best in an effort to follow this strategy through so you can see how it progresses throughout the year, comparing it to the benchmark, the S&P 500, and that would give you a good idea of how well this strategy will hold up over time. Now, if the S&P 500 is in a strong bull market, the S&P 500 is going to do better, generally speaking, than this trading strategy. But if the S&P 500 is trading sideways or down, having this portfolio will beat that portfolio because of your diversification and your selling premium. So you're going to do better on your return on investment with that. So that is the huge benefit of having this type of diversification. So that's it. I hope you got something out of this video. I will see you later.